Right. Hello, everybody, and welcome back to this seminar series. My name's Natacha Postel-Vinay. I'm an assistant professor at the London School of Economics. And today we're incredibly happy to have Claire Célérier and Punoor present today. So Claire Célérier is an associate professor of finance at the University of Toronto at the Rotman School of Management. Claire's research explores how finance can benefit households, and it investigates the role of innovation and the impact on diversity and inclusion. Punoor is a PhD student at the London Business School and focuses on very much the same areas. Just a short reminder of the rules for this seminar. So you can ask questions that will mostly be dealt with at the end of the talk, but please write your questions in the Q&A space, not in the chat box, please. This is found below on your screen. If you want to ask clarification questions, this is fine, but please do flag them as clarification questions. So you can ask them in the Q&A box again, but please flag them, hashtag clarification so that we know they're clarification questions. And I will sort of choose a little bit whether these are worthy of clarification. Then the only thing I would like to add at the end is that only the moderator, i.e. myself, will be able to stop the presenter for those clarification questions, right? So only I can do that. You can't really unmute yourself and clarify or ask the presenter to clarify things. All right, so without further ado, please, Claire, go ahead. And yeah, we're very enthusiastic to hear your presentation on the rise and fall of the Freedman Savings Banks, which I believe is the first bank to cater to Black minorities in the south of the US after the Civil War.
Yes, you are right. Thank you very much for having me. It's a great pleasure to be here. And so, yes, I'm going to talk about the Freedman's Savings Bank, and it's a joint paper with Punoor, who is also with us today. So policymakers and academics have pointed out the disparities in financial markets as a driver of the wide and persistent racial wealth gap. And so these racial disparities span many access to credit to basic financial services such as a bank account. And to illustrate, while accounting for 13% of the population, African Americans represent 1/3 of the unbanked in the US, and they cite mistrust as one of the primary reasons. And so the objective of this paper is to give a historical perspective on these racial disparities by investigating the rapid and broad expansion of the first formal institution targeting African Americans after the Civil War. And we're also going to investigate its collapse. So the Freedman Savings Bank was created right after the Civil War in 1865, and it was supposed to be a benevolent institution collecting deposits from the African Americans, which represented 4 million individuals. Within 7 years, the institution has been able to collect close to $100 million 2021 from more than 100,000 households across 17 states, in spite of continuous deficits and frauds, which finally led to the failure of the bank in 1874. And so in our paper, we address 2 research questions. The first one, how did the bank build legitimacy and trust among recently freed African Americans? What was the role of advertising? And how did the institution turn into the black man's co and the white man's milk, as Frederick Douglass wrote in 1874? So we have 4 main results. So what we show is that the Freedman Savings Bank became popular through a uniquely extensive advertising campaign. The bank promoted itself using false promises more than any other bank at this time, and also a moralizing rhetoric. We observed that the misleading advertising intensified with the fraudulent use of funds to the benefit of elite white networks, which at the end led to depositor losses rarely matched in the banking history of the US. So we contribute to several trends of the literature. So we contribute to the literature on racial disparities in finance. And so we show that we give a historical perspective on these racial disparities. And we show also that financial institutions can discriminate not only through prices and quantity, but also through the advertising. We also contribute to the literature on the cost and benefits of formal inclusion in financial institutions, showing that in some contexts, it can be costly for minorities. We also contribute to the literature on diversity and bank governance. And finally, we contribute to the history literature on the Reconstruction era. I'm going to give you some institutional details about the Freedman's Savings Bank. So the founders of the Freedman's Savings Bank were white prominent church members, businessmen, reformers, and abolitionists. And they initially organized the bank following the principles of the savings bank movement of the 19th century. So this movement started in Europe, and mostly in the UK first, and then in France, Spain, and Italy. And then he arrived in the US a bit later, and the savings bank were opened mostly in the northern states of the US. And so initially it was a benevolent institution, and it had a broad social agenda, which was to educate it and elevate the former slaves by teaching lessons of thrift. It was also in line with the free labor ideology. So after the Civil War, there was an attempt to give to the freedmen some land to get access to wealth, but this attempt was quickly abandoned, and instead of ideology was to encourage the freedmen to work and to save their wages to get financial independence. So this graph illustrates a bit the development of the Freedman Savings Bank and then its collapse. And so you see the bank was created in 1865 and it collapsed in 1874. And so on this graph, you see the amount of deposits that was collected and the number of accounts that were opened. And so we see an exponential growth until more or less 1872, and then the collapse in 1874. So the savings bank was part of this free labor ideology and savings bank movement, but it was also a unique institution in several dimensions. So first, it was operating largely in the South, where at this time there was almost no savings bank. The Freedman Savings Bank was also the first institution offering banking services or banking account to the freedmen. And it was also the first bank branching across states since the second Bank of the United States, and one of the only banks. So at the time of the Freedman Savings Bank, interstate branching was banned. So that was the only bank with branches across states, which of course raises challenges for the monitoring and supervision of the bank. And so this map plots the location of the branches in the US. And so what we show also all the US counties, And so the darker the colors, the wealthier the Black population in this county is. And so what you can see is that there were like branches were scattered across 17 states, mostly in the south and east part of the US. And of course, branches were not open in random places. So you see that the location of branches in counties with a significant amount of wealth for African Americans. So from the beginning, there were some governance issues at the bank. So first, the directors, which were white, had no incentive to properly monitor the bank. They had no financial or legal incentives and zero liability. And none of them resided in Washington, D.C., where the bank headquarters were during most of the life of the bank. Which is in contrast to what was national bank. So at this time, regulators were aware of the importance of aligning the incentives of the directors with the one of the investors or depositors. So because, for example, for national banks, directors were required to be shareholders, and they were even subject to a double liability rule, and they were supposed to live close to the headquarters of the bank. There was also some ambiguity about the composition of the asset and liabilities. And also, like the bank was not supposed to make loans, but within 2 years, it started making loans with absolutely no equity and any kind of capital requirements in the regulation of the bank. And another issue is like the location of the branches. So the branches were scattered across the south, while interstate branching, again, was prohibited for other banks. And we can see what could be the challenges of supervising a bank with branches across 17 states at this time. So our first results are about the extensive advertising of the bank. So what we do, so we collect the advertising of the bank and any other financial institution from newspapers. So first what we do is that we build a sample of newspapers, and we are going to screen these newspapers over the life period of the bank to collect any advertising of any financial institution. So we have to define our sample of newspapers. So to do so, we focus on the 5 main states with branches, which are Virginia, South Carolina, Georgia, North Carolina, and Washington, D.C. So they more or less account for 60% of the accounts available in the registers. And we also include New York because New York City at this time was a financial capital. And a lot of savings banks were in New York. And for each of these 6 states, we build a sample of all the digitized newspapers targeting African Americans and 1 or 2 newspapers, depending on what is available, with a large and general audience. And so just to illustrate, our data set includes some newspapers that are still existing, such as we have also the New York Daily Tribune, Evening Star, and the New National Era, which was like Frederick Douglass newspaper. And so then what we do is that we collect any newspaper item mentioning any financial institution, and we manually transcribe them over the 1865 to 1874 period. And we also focus on the advertising of comparable banks. So what we do is that we identify 2 other banks that were also targeting minorities, which are immigrants. So we focus on the German savings banks and the immigrant industrial savings banks, which was targeting the Irish population. And then we collect any newspaper item we find about these banks across any newspaper, even beyond our sample. So we arrive at a data set of more than 3,200 articles across 17 newspapers over the 1865-1874 period. We also exploit data from the registers of signatures of the bank. So for 27 branches, we have access to the registers of the accounts. And so, which means that we have access to the account opening date, account number, first name and last name, age, occupation, race, relatives, and place of birth. And so we have access to the identity of depositors for 74,000 accounts across 27 branches. So our first result is about the extensive advertising of the bank. So what we find is that this is by far the most advertised bank. It is the only bank with advertising in all newspapers in our sample. 30% of all electors. And even after we exclude newspapers targeting African Americans, around 19% of the ads are about the Freedman Savings Bank. And so the Freedman Savings Bank is even advertising more than the largest savings banks at this time. So we compare to the largest savings banks that were in New York at this time. And so to illustrate the extent of the advertising, the New National Era was the reference journal for African Americans at this time. This was Frederick Douglass newspaper. So each week, the newspaper would include 2 columns in the front page on the Freedman Savings Bank. And so it was like much more than for any other institution at this time, even schools or the Freedman Bureau. So in total, the 450 issues of the New National Era included more than 500 pieces on the Freedman Savings Bank. So we do an empirical analysis to investigate the impact of the advertising on the number of accounts that are opened. So we use the data from the registers. And so for each day, we have the number of new accounts that are opened in each branch. And we exploit the fact that most newspapers were local newspapers. So we can identify the advertising in a given branch at a given point in time. And so we do find a positive relationship between the number of articles and the number of new accounts that are opened. And yes, and then we look at the content, and I'll go back to that. And then we identify, we investigate the content of the advertising. And this is where we identify a large use of false promises and demoralizing rhetoric. So just to illustrate, so this is a weekly ad from the New National Era. And so it was offering 6% interest paid on sums of $5 or more. And this great, it was described as a great national savings institution, and it was insisted on the fact that it was established by the authority of the United States government. And an example of a moralizing rhetoric: cut off your vices, don't smoke, don't drink, don't buy lottery tickets, put the money you save into the Freedman Savings Bank. So this is, again, another example of an advertising of the Freedman Savings Bank. So promising that they were offering advantages that are in fact unsurpassed, and also promising that the deposits were safe. All money left with us is safe, as secure as real estate security, government bonds, the best safes now made, and honest cashers can make it. And so also with this idea of safety of the bank, you see that was the image of a deposit book. And so you see the image of Abraham Lincoln, and also some important general in the Civil War from the Union Army. And you see like the hand of Lincoln on the safe, as if like, and also of course the eagle as a symbol of the United States, as if these deposits were guaranteed by the US government, while it was not the case. So based on what we observe in the advertising, we make the assumption that the Freedman Savings Bank used the positive language, overstatement, promises, and moralizing rhetoric. And so what we do is that we use existing word list from the Harvard Inquirer's Dictionary to identify the corresponding categories. Okay, so we want to identify just the use of positive words, but also overstatements, false promises, and moral exhortation. Okay, so the false promises will be about how safe the deposits are, the prosperity of the bank, and also the relationships with the US government. The moral rhetoric will be about, will refer to vices, to religion, and to persons of authority. And so in this graph, we plot the intensity of the use of these word lists for the Freedman Savings Bank and other banks. And so we see that articles relating to the Freedman Savings Bank were much more likely to include positive words, but also overstatements, false promises, and the moralizing rhetoric. And to get a more robust result on the content of the advertising, we run an OLS regression. And so we regress the intensity of the use of positive words or overstatement or moral exhortation or false promises. And so we regress on a dummy for the Freedman Savings Bank. And so the objective of the OLS regression is to be able to control for a newspaper fixed effect, bank, and the type of the newspaper and year fixed effects. And so we do observe that the Freedman Savings Bank is much more likely to use false promises and moralizing rhetoric, as well as positive words and overstatements. And so what we do also is that we include a DB for minority banks. So as said, we have focused on the Immigrant Industrial Savings Bank and German Savings Bank. But we do not observe the same type of advertising at all. And our interpretation of this result is that this is not the case, because in these banks, the management of the bank was aligned with the interest of the depositors, because they were from the same ethnic origins. So, for example, the management of the immigrant industrial banks were often were Irish, and often even part of the Irish church. So to illustrate the use of false promises, so the Freedman Savings Bank will make 3 types of false promises. The first one is about a government guarantee. So, for example, in one newspaper, we read there is no possibility of loss for that the government of the United States is for the reason that the government of the United States is responsible for every dollar deposited. So we are more than 50 years before the creation of the FDIC. So there was no deposit insurance at this time, while the failure of banks was relatively frequent. So of course, the promise of a government guarantee had a lot of value. There was no government guarantee. It was a private institution, and when the institution finally failed, depositors were not insured. The advertising was also making false claims about the safety of the bank. All money left with us is safe, as secure as real estate security, while very rapidly the bank started loans, fraudulent loans. And then about the prosperity of the bank. So the bank was in deficit almost every year, but it was always claiming in the advertising that it was very prosperous. So in terms of moral exhortations, so investing in the bank was considered as a duty. Mark this that industry, sobriety, economy, and a good moral character lead to wealth, education, influence, and power. There were also many references to religion, the blessing of the savings bank, for example. And also they were also often making reference to persons of authority, such as the philosopher illustrated with like the image of the deposit book I've shown you just before. So in comparison, the advertising of other banks is much more neutral. So in fact, we are at a turning point in the history of the advertising in the US. So we are still advertising informative. And so, for example, like this ad for the Memphis German Saving Institution will give information about the address of the branch, the list of directors, and the business they will do. So this is very representative of what was the advertising of other banks at this time. So now I'm going to show you evidence of fraudulent lending and how it relates, how the fraudulent lending relates with the misleading advertising. So the bank lending policy. So initially, the charter stated that deposits should be invested in government securities, which was the norm for savings banks at this time. Savings banks were not supposed to make loans or only under very strict conditions. In 1891, the bank started making loans violating the bank charter. And in fact, the directors of the banks, they lobbied Congress to get a change, to get the charters changed to facilitate lending. And so they finally succeeded. And on May 1870, Congress amended the charter and allowed the loans conditions. So normally the loans were supposed to be only real estate loans, and the collateral should be twice the value of the amount of the loan. So to investigate the lending of the bank, we exploit data from the loan register. And so we have access to all outstanding loans in 1874, and so we manually transcribe the information. And we collect information on the borrower's identity, loan amount, issuance, due date, and percentage due. And so we collect information on close to 1,800 loans. And then we exploit historical archives to identify borrowers and to identify the wise occupation and network of the borrowers. And so this is what we find. So depositors were mostly African Americans. 90% of the depositors were African Americans, while most of the loans were offered to white individuals. And so what we show is that these loans were mostly offered to white businessmen in Washington. There is also a contrast in the geographical composition. Had branches across 17 states, and so depositors were like spread across the US. But in fact, the money was collected in branches and then transferred to Washington, D.C. And most of the loans were made in Washington, D.C. So there was a transfer of money, not only from African Americans to white businessmen, but also from like the South to the capital, Washington. And so we find evidence on fraudulent lending. So first, almost all loans violated the charter regarding the loan and the collateral rules. So a lot, like most of the loans, a lot of loans are not real estate loans, and almost all loans are not satisfying the collateral rule. So, for example, for a very large loan, what was used as collateral was just furniture, and a lot of loans were for investment in stocks, for example. And so, like, because we have the identity of borrowers, we can make connection with the network of the directors, and we can identify some insider lending. More than 50% of the loans benefited real estate contractors, businessmen, financiers, and also elected officials who are really part of the network of the white directors in Washington, D.C. And so 15, like for example, more than 15% of the loans went to elected officials, like from Senate or from the Senate or the House. And more than 95% of these loans were not repaid, suggesting some strategic default. So we find a correlation between the fraudulent lending and the misleading advertising. And so this graph plots, so like the bars represent the amount of loans. And so the light gray shows the light gray bars show the issuance volumes, non-performing. So we know that these loans have never been repaid. And so you see an acceleration from 1870 to 1872. And the red line and the black line plot the intensity of the use of false promises and moral statements in the advertising of the bank. So there is a relationship between the increase in the fraudulent lending and the misleading advertising. So the fraudulent created after 1869 is because of a change in the management of the bank. And so the new directors of the bank in charge of the finance committee, which was making the decision about the investment of the bank. So the new members of the new directors in charge of the finance committee were started making loans to their connection and were connected to different networks in Washington, D.C. So, for example, we have the brother of Jay Cook, who was part of the directors of the bank. So we do a deep analysis to confirm the robustness of this result. So we are not making any causal statement here, but we do have like qualitative evidence that they increased the advertising effort when they started using the funds for fraudulent lending. And so we regress the use of positive overstatements, moral statements, or false promises on a dummy for the Freedman Savings Bank interacted with dummy indicating the period after the change in the charters. And we include year and bank type fixed effect. And so we do observe that the intensity of the use of moral statements and false promises increases after the change in the charter amendment, which facilitated the fraudulent lending. So sometimes I have questions about whether or not this transfer of funds from African Americans to white businessmen in Washington could be efficient. So it's important to have in mind that depositors did not collect any returns from the risk investments. Okay, so they did not compensate deposit more after investing more in risky assets. In fact, depositors were almost never paid the 6% interest rate that were due to them. And the borrowers were like very highly connected businessmen in Washington, so they already had access to banks, while depositors did not. And so, for example, Jay Cook benefited from a very large loan as he owned an investment bank at this time. And also, we have qualitative evidence that the collateral requirements were much stricter for African Americans. We investigate the of the bank on depositors. So one assumption we would like to test is whether or not depositors benefited from the Freedman Savings Bank at least at the beginning. So it could be the case that thanks to these branch networks, African Americans have been saving more, which would have benefited them in the short run. So what we do is that we merge the register data with the census data. And then in the census data, we can observe outcome on like education, income, wealth, and occupation. And so what, but like we have census data only for the year 1870. And so what we do, so the decision to deposit money at the bank, of course, is endogenous. So on average, depositors are wealthier and more educated than non-depositors. But so what we do is that we focus only on depositors that we have identified in the census, and we compare depositors who already have an account in 1870 to depositors who 1870. And so we expect late depositors, in fact, to be more sophisticated than early depositors, and even the opposite, because like in 1871 there were already rumors about the investment of the bank, and also because after 1870, for example, the bank was massively collecting deposits from children. And so we look at different outcomes, such as the probability to attend school, to be literate, to work, and income or real property wealth. And we find no difference between early depositors who already have an account in 1870 and late depositors who don't have an account in 1870. So we do not find any evidence of short-term benefit saving, which like should not be that surprising, given that the bank was not granting loan to African Americans. It was just about collecting deposits with almost never paying any interest, knowing that maybe it was the first formal institutions collecting deposits from African Americans, but African Americans were already saving before the bank, for example, massively saving through churches. So it might be also more like a substitution effect. And then we investigate the depositor losses. So what we find is that in present value, depositors individually recouped only 20% of their deposits on average at the date of the failure. So if we compare to other failures at this time, so for example, for the Bowling Green Savings Bank, which failed in 1871, it led to depositors' losses of only 6% versus 80% in our case. And so the reason why in present value, like the amount is also relatively low, is that depositors were repaid only after a certain amount of time. The last dividend was paid only 9 years after the failure of the bank, which is a lot when you think that the life expectancy of African Americans was below 40 at this time. And in 40 years, the controller of the currency negotiated with Congress for depositors to be fully repaid without any success. And so when we compare, so what we do is that we compare to the failure of other banks in the history of banking in the United States. And we find that this is in the very top in terms of the amount owed to depositors as a percentage of GDP, which is considerable because we're talking about a relatively poor population. So it is one of the largest failures in terms of depositor losses in the banking history of the US. So it's time for me to conclude. So in this paper, we shed light on how the first formal institution targeting African Americans collected deposits through an extensive advertising campaign using false promises and moral statements, and led to a transfer of wealth from African Americans to elite white networks in Washington, D.C. And so these findings have possible implications, and also like it raises future research questions about the long-term impact, trust, and the possible effects, and also potentially the benefits of Black-owned banks. We also provide evidence on how advertising by financial institutions can be harmful to minorities, which potentially give rooms for consumer protection. And we provide evidence of misleading advertising in a context with low regulation, which has potential implications for less regulated markets, such as fintechs or cryptocurrencies. And so this is an example of cryptocurrency company advertising to African Americans using Spike Lee. And I'm not going to show you the video, but it's a good example of misleading advertising targeting African Americans. Thank you very much, and I am looking forward to your questions and feedback. Thank you.
Thank you very much, Claire. That was really interesting. And I should thank Punoor as well, even though she hasn't actually talked, but she's answered a live question. So that was very helpful. Thank you very much. So remember that you're able to ask questions in the Q&A box below. We have already one question by Pamphili Antipa. Pamphili, would you like to ask your question live, or should I answer it? Should I ask it? Sorry. I'll just ask it. So the question is, what was the government's position regarding the bank, and how did the bank obtain its charter? So I think it's a question about sort of the beginnings of the bank and how the government thought about the bank and how it allowed the bank to get its charter.
Great. Thank you very much, Pamphili, for this question. Punoor, would you like to answer the question?
Yeah, sure, I can take it. So this bank was chartered at the same time as the Freedman's Bureau, which was again kind of started during the Reconstruction to kind of incorporate this new population recently freed from slavery. It was at the request of some preachers, some people involved in the savings bank movement who were interested in, again, using this idea of self-help to empower the recently freed slaves. And so this was actually one of the last acts of Congress that were signed by Abraham Lincoln right before his assassination. And it was really the only bank at this time that was kind of under the purview of Congress. All other national banks at this time were regulated by the OCC. So hopefully that answers your question. But let me know if you have any follow-ups.
So yeah, and about the government did. Congress did charter the bank, and then Congress was supposed to be in charge of the supervision of the bank, and in fact, it almost did not pay any attention of the supervision of the bank, and it's only in 1872 that they started auditing the bank because they were aware that some issues were happening. So I would say that there was some, while the bank was chartered by Congress, there was clearly some disregard about the supervision of this bank compared to what was happening for other banks at this time.
Oh, thank you very much to you both on this. Actually, I had a related question about this, which is, what was sort of the original intention of the bank's founders, really, in terms of what was going to happen on the investment side, so on the asset side? Because I understand that from the start there was an intention to cater to Black Americans in terms of having a safe place to put their savings in, and including potentially earning some kind of interest on this. But what were the intentions in terms of what was going to happen on the asset side? So did they clearly saying that they were going to cater to Black Americans also on the asset side, so to lend to them, or to, invest in, I don't know, securities that had to do with Black businesses or whatever, if there were probably none, or very few, but, what was the intent, or did they know from the start, were there maybe, it might not be a form of cynicism, but did they know from the start that on the asset side, it was probably going to cater more to white communities as opposed to Black ones?
So it was set up purely as a savings bank, and the intention from the get-go was that they would only be investing in government bonds. But of course, this is what the charter had kind of specified. But of course, we know kind of as early as 1867, they were investing in really risky loans, mostly in railroads at that time. So it was never the intention to extend credit, for example, to these depositors. It was really just set up as a pure savings institution.
Okay, because I read in the paper that it says that a third of deposits could be used with no obvious restrictions, but is that how is that linked to investing in non-government bond securities? Was that actually allowed or not? Or
so there was some ambiguity in the charter for sure, but my understanding is that the intention was to have some fund available for like wages or like in the form of cash to run operations. But clearly there was some ambiguity there that was quickly exploited.
Okay, interesting. Thank you.
I would not say I think the intention of the funder was really to provide African Americans a way to save. So there was some kind of paternalism, and which could be interpreted as racism and so on for sure. But no idea of fraud from the main founder of the bank.
Okay. Well, thanks very much. That really answers my question. So we have a question by Maëlys Avaro. Would Maëlys like to ask the question live? I can't see her anymore, actually.
Hello.
Oh, there she is. Oh, yeah.
Thank you very much for the paper. I had two questions. The first one was, do you have any micro information on how the loans to the white people were used for, what type of projects were financed? And the second question was regarding the collateral rules that were not respected in providing these loans. Were these rules in line with collateral requirements of the banking sector of the area? Was it common that banks would ignore collateral rules, or was it something very constraining on average in this sector at this period? Thank you.
Punoor, go ahead if you want to.
Sure. So we do have micro data on the types of loans that were funded by the bank. So in the early kind of years, a lot of this went into railroad investment, and that was because of the close association between Jay Cooke's investment bank, which primarily invested in railroads, and Henry Cooke, his brother, who was part of the management team of the Freedman Savings Bank. But primarily, though, what we see later on is that these loans are really for personal use, and for personal use by people that were in kind of the close personal networks of the management team of the bank. So we see a lot of loans to politicians, congressmen, and to real estate developers and contractors in DC. And for your second question on collateral, so it's a little bit different. So some of the national banks at this time, they were regulated under the National Banking Act of 1863 and 1864. And those banks had kind of a different rules kind of governing their lending. So actually it was quite restrictive in terms of mortgages, which is in fact what the charter amendment of the Freedman Savings Bank was allowing eventually for lending. So it's a little bit different to compare, but I don't know, Claire, if you want to add more there.
Yes, and so like it was very similar though to the regulation of other savings banks. So other savings banks could do some real estate loans, the same collateral. And so whether or not these collateral rules were followed, so there was also fraud in other banks. So fraud was relatively common at this time. There was some issues with the supervision of banks and so on, but never to this extent. So we did investigate the failure of a couple of savings banks, and it never led to depositor losses to this extent. So there are some other examples of frauds, but clearly not to this extent.
Yeah, thanks a lot to you both. Yeah, 20% is really so small. I have not seen that in many instances in history. We have another question from Simone Wege. And the question is about branching and the kinds of opportunities or risks that branching led to. So I'll just repeat the question here. So the Freedman Bank opened many branches, which is not what the Emigrant Bank did, one branch in New York. How did the branching efforts open the Freedman Bank to more operations where new people could operate outside the mission of the bank? I think it's about risks linked to branching.
Okay. Well, I think one thing just, why the Immigrant Bank didn't really open many branches is because the population they were meant to be serving was in a very tight geographic region. It was mostly in New York. And the same kind of goes for the German savings bank, whereas of course the Freedmen were kind of spread all across the South. In terms of the, so I guess I'm not really that clear on the second part of the question.
I can answer, yes. So yes, so I think that, of course, the fact, like it was the only bank that was spread across states at this time, and of course, it maybe it encouraged like the massive fraud because it was difficult to monitor banks across states. But at the same time, the fact that there were branches opened everywhere is endogenous. Because it's because there was some disregard for the monitoring of these banks that they let the bank open branches everywhere, and they had even more incentives to open branches when they're starting using the fund for fraudulent use. So we do not find a perfect control group or a perfect comparable. So we try to go as close as possible with these banks targeting migrants. One big difference is that these were not interstate branches, but the fact that there were some interstate to issues of the bank.
Yes, and I assume the loans actually were pretty concentrated, right? So instead of being diversified over these different states, they were actually quite concentrated into these sort of white, wealthy communities, from what I've seen
in Washington.
In your work. Yeah. Right. So let me ask you just one. I had actually a couple of other questions. So first of all, were there any shareholders? Was this, a company with shareholders, and was the bank listed on a stock exchange? And do you have any prices? No. Okay.
The bank was owned supposed to be owned by the depositors. It's
owned by the depositors.
Yeah, it's a savings bank. So the status of the savings bank is that it's like a mutual savings bank. They invest in the money, gives them a right on the asset, and the directors were supposed to act on behalf of the depositors.
And were the directors kinds of partners, or what was their liability after?
Zero. That's the issue.
Okay.
That they had even no money in the bank. Like when they would get loans, they would just invest the loans somewhere else. Like it's not a traditional banking model. So the bank was managed by this white businessman with absolutely no incentives to properly manage the bank and zero liability, because at this time they thought that African Americans could not. It was explicitly written in a letter from the founders that they could not manage properly a bank, and they could not manage loans properly, and so on. So that's why they gave the management of the bank to white businessmen. So you see that from the beginning, there were risk of a misuse of the funds.
But did depositors have some kind of right to appoint directors, to vote for directors, managers, or something like that?
This is the founder who nominated the directors.
Right.
So there was nothing clear about that in the charter of the bank about how the directors would be nominated. They were supposed to be.
And was this common was this corporate structure common? Was this the normal corporate structure for savings banks at the time?
So this is a good question that we need to investigate more. I don't know, like Punoor, you're the expert in savings banks, so do you know how directors were nominated usually for other savings bank, or do you have examples?
Yeah, I think a lot of the earlier ones, especially when they started in the UK, it was very much the trustees. I mean, it's a bit of a different system in the UK, but it was the trustees and the existing managers who would kind of nominate each other. It was very much not the model that you'd have depositors be the one, choosing or voting on.
But there was some liability rules, though.
Exactly. So I mean, so the Freedman saving, it's a very stark example of where there's absolutely just no alignment of incentives between the managers
Right, so
and the.
normally there would be like double liability or something like that for directors at least.
Yeah, managers would have some more skin in the game. Yeah.
Okay, very interesting. Thank you. So Rui, I think Rui has a question.
I do. May I just jump on what you were saying? So even in the UK, building societies were also built up in this mutualized system, right? They were also formally owned by the savers, the depositors, right? But there were, more direct incentives because they were essentially created to provide mortgages, and of course you need to put the collateral, not only the house but also your life savings, right? To align the incentives. But they also got into a crisis in the 1890s because of faulty management incentives. But I wanted to ask two questions, or maybe three. So you found significant evidence that paid printed advertising had an impact on the opening of accounts. But this surprises me as a way of targeting what I imagine was largely an illiterate population at the time, right? So they probably didn't read these journals, right? So who read them to them, right?
Yeah.
So what was actually the network? So that would be the first one. So second one, so you also found this correlation between 1870 Black wealth measure and the location or the opening up of the branches of the Freedman's Bank. But what kind of wealth measure did you use? Did you use personal estate or real estate? Because if it's real estate, right, so this is illiquid wealth. So unless there's some kind of financial transaction in the background, right, that allows you to take equity out of your real estate, I wonder, right? And also, how is this connected to the Homestead Acts, right? Did you try to see whether states or counties where more African Americans got land, right? The famous 40 acres, also predicts the opening of these branches. And then finally, why was there no run on these deposits, right? Because the pattern of financial impropriety, to call it, an euphemism, was so obvious and for so long, right? If people didn't see their accounts being credited with interest, why did they stay? Thank you.
Punoor, you want to answer these questions?
Sure. So the first one on why we use newspapers. So this is really, you're absolutely right. A big chunk of this population was illiterate at this time. We're really using that as a proxy for how intensive the advertising campaign of this is, because it wasn't just newspapers. This went alongside a lot of public meetings. Cashiers of individual banks would hold these public meetings and stuff. So this is really just a proxy for kind of how intensively they were advertising locally, and in these speeches and these public meetings, they would say virtually the exact same stuff that we see in the newspapers.
So yeah, we do observe only one fraction of the advertising, but what was common at this time is that one person would buy the newspaper in the community and read it to the rest. So that's the way. That's the best way we have to proxy the advertising. We also have information about public meetings and so on, but it's much more difficult to exploit. And so yes, again, only 20% of the depositors in our sample were literate. But again, like there was this tradition of like one person reading the newspaper to everyone in the community. And again, this is the best like we can get to get a proxy for the intensity of the advertising.
Okay, just to interrupt you, sorry guys, I have to go, but you can answer the rest of Rue's question just after I leave. Is that okay?
Yes, perfect.
Thank you.
Thank you so much for this talk. This was really interesting in terms of corporate governance and lots of other issues as well. So yeah, thank you so much.
Thank you so much.
Yeah, see you later, I hope.
Yes.
Bye.
Thank you. Bye. So Punoor, do you want to answer the?
Yeah, I can take the second one too. So we're using the sum. So this was about wealth. So the correlation we're showing between wealth and geography. This is the sum of both personal wealth, which includes, more liquid assets that you were talking about, and also real estate wealth. So we're using the sum. We can try to, divide it up. I think we've tried that too. There wasn't really much of a difference.
So in the paper, we use different proxy for local populations' access to wealth and education, and we always find a positive correlation. Like branches were not, like what we want to say is that branches were open in places where they knew they could collect money from African Americans. This is what is explicitly written in the letters from the founders. This is what we would expect, and this is what we observe, even if we use many different proxies for access to wealth and education, like for example, the presence of infrastructures and so on. So this is only one, but it works across different measures.
Yeah, absolutely. And your question on the Homestead Act, I think that's something we can maybe look a little bit more into, but from my understanding is a lot of that land was in the West, right? I think west of the Mississippi, whereas we're looking, you know, this bank was mostly in the South, kind of East, right? Like the traditional Southern states. But yeah, we can definitely, think more about that. And your last question was on whether or not there was a bank run. Eventually, there was at the very end, you know, that there was this information that the assets of the bank, the loans were all fraudulent. They weren't going to be able to recover anything. There eventually were lots of kind of instances of people trying to run the bank. What the bank ended up doing to try to kind of maintain some stability was it instituted this 60 days rule. So if you wanted to withdraw anything towards the end of kind of the life of the bank, you'd have to give them 60 days notice. So essentially they really did try to hold on as much as possible at the end. People were aware in the last few months. Yeah, they were trying to get their money out.
Most of the first runs happened in September 1873 with the failure of J. Cook. And this is when people started understanding that there might be some fraud and misinvestment there and so on. But this is when it really started, and indeed they did their best to establish and keep the fund in the bank, and it finally failed in July 1874.
Yeah, but it is strange, right? Because if this were just a pyramid, right, at least they would, you know, the managers or the directors would try to pretend that the interests were being credited to the accounts, but apparently not even that, right?
So they were not paying zero interest. They were paying interest when people would complain. So they did pay interest in some instances, and then the advertising was really misleading because they were what the white directors knew was not known to everyone, and so like for example, like Frederick Douglass advertised a lot about the bank until almost the very end. So he had some interest because his newspaper was partly funded by the bank and so on. But you see that they wanted to believe that it could. Some people wanted to believe that it could work, and so maybe also like Frederick Douglass played a role here.
Yes, Melis Alvaro has a further question which is related. Melis.
Yeah, it's really a follow-up from why were there no run, and so the question would be if that was kind of obvious, were there members from the African American communities trying to denounce the activity of the bank and trying to fight the extensive advertising, or trying to at least nuance or provide some, like what the Fed does these days when you have the crazy crypto ads around? Like, were there anyone fighting them from the side of the African Americans?
So fighting against the advertising, I don't, you know, not really to even towards the end, but of course, when there was, you know, some more of this information out there about the poor kind of financial condition, people were trying to withdraw and get that word out. But yes, not so much, I think, fighting against advertising.
There are some examples about African American. So at the end, they did appoint some African Americans directors to gain African Americans. And some of them did complain and try to control a bit the activities of the bank. That's why, in fact, so the finance committee resigned in 1872. So they did this massive fraud mostly from 1869 to 1872, and then they resigned because they started having some suspicions within the bank, and so it did have some effect. And so from 1872 we have like much less fraudulent lending, and it's just about trying to recover. So there were some complaints and actions. It's mostly about control, like about the investment of the bank. We don't have evidence about the extent of the advertising. We don't have evidence, like there might, but we do have evidence of African American directors complaining about the investment and the fraudulent use of fund and so. But it was not. It took time for them to realize also, because the finance committee, there were 3 directors. They were mostly like they were very good friends. They were making their decisions without any supervision or monitoring. And so we do know also that sometimes they were using some secret code to communicate between each other. So they tried really to hide this as much as possible, claiming that everything was fine and prosperous. But they did have to resign in 1872. So there was some opposition within the bank from African American directors mostly. Yeah.
Okay, thank you.
Hi, so I'll jump in. I have a couple of questions as well. Just in terms of the dynamics of this and relating to Rui's comment about whether this was a Ponzi scheme or some kind of a pyramid. So you can see from the figures you present that something, so now you gave a partial answer to the change in 1872. But you see that in 1872, all these activities of excessive advertising and so forth declined substantially. Also, you see that from then on, there's in terms of new accounts, there's less new accounts being opened. So obviously, the advertising was related to the new accounts. So on the one hand, you see this side of what's happening in the bank, and on the other, again, it's just looking at the figures, it's not a regression, it's kind of an ocular regression. But in 1872, you're seeing that these loans increase a lot. So just when they stopped these advertising campaigns and when depositors started to kind of, then you just suddenly see this massive increase in loans. So is it that at that time, sort of they felt the bank is folding and might as well disperse all this money? I mean, so this is kind of tunneling or some kind of other practice where you see the business is about to fail, the business model is not going to succeed, and basically you just, so it adds a little bit more of an interesting dynamic to the story about what's happening in 1872, which is really striking. That the fraudulent stuff goes down, but the loans go up, and deposits already are going down, and so the deposit growth has stalled, and it's so again, just can you say something about this dynamic? It looks as if they're trying to kind of clear the whole thing. Just
So so this is very interesting. I think it would be fascinating to explore a bit more what happens exactly in 1872. So it might be the case that just before resigning, like the directors of the finance committee, they started as much as to capture as much funds as possible before resigning. It would be very consistent with what happened overall. We could explore that if we explore like the exact date of the loan compared to the resignation of the committee, and this is something we should do. Thank you for this question.
Yeah, and also just to add, 1872 is also the year. So this is the year that the bank is actually insolvent. When you look at when you compare their assets and their liabilities, and so I think it's very plausible that it is this. They don't know how much longer they can keep this up. You might as well take all the money you can out and at that point, and then leave or resign.
But we could explore that.
To look this more, yeah.
We could explore that with the dates of the loans comparing.
Yeah, it would be interesting. I mean, I have we wrote about the London Corporation, so it wasn't like a Ponzi scheme or anything, kind of fraudulent to begin with. But close to the default, where you see the insolvency coming up, the insiders actually cash out. But here it will also be interesting to look at the depositors, which depositors cashed out before. So these are the loans given to the friends of the directors. But also it would be, because you have all this great data set, who are the ones that are cashing out before the default? Are the people in branches closer to Washington, or are the people closer to the management, or more wealthy, less wealthy? So, what we found in London is that the least informed people, the widows and spinsters, all these people that were kind of, they kind of were stuck until the end, where all the insiders, not just the directors, but the insiders cash out before. And so again, it might add interesting dynamic to the story of winding down this, even within the Black community that were most of the depositors, whether there were, it makes a story a little bit more, now it's a white versus Black thing, where sort of the Blacks deposit, the whites skim it off. But it could be a little bit more interesting if you look at the dynamics of those who.
So white, mostly the borrowers were not depositing money in the bank, so it's more about like taking more loans. And then about like the identity of the depositors, it's indeed a very interesting and important question. There is a paper on, in fact, about this. So we have, I could send it to you if you're interested. There are some researchers that are investigating. So they have issues in the identification and so on, but they do investigate like the timing of the withdrawal and the relationship with the identity of the depositors.
I think we're running out of questions, if I understand correctly. Just out of curiosity, would it be possible to study what happened to the depositors who lost 80% of their savings?
So that, you do want to answer, Punoor?
Yeah, I mean, this is tricky, and this is, I think, ultimately the big question we're all after as well. So one thing that's kind of a little challenging is to identify people across censuses. It's not a trivial task. You know, just matching the same person from the 1870 to the 1880 census is quite tricky. So yeah, it's challenging. I think the records on exactly who received which dividend at which point in time, it's also yeah, it's challenging to link the data, but I agree. I think this is ultimately like the really interesting question after this. One of the first, you know, the thing we always have in the back of our minds as well, are there actually intergenerational effects of a failure like this in terms of trust in financial institutions down the line? Because we see that even today in the 2019 FDIC survey, that it's precisely kind of this population that still seems to mistrust banks the most. But yeah, it's not trivial linking over censuses.
And so there are researchers that are like, I don't know if you know Rick Hornbeck from Chicago, for example. He's been working on this for like 6 years because it's very challenging to track African Americans over time. First, it's challenging to match the data with the 1870 census, and the 1880 census is basically missing. So then you have only the 1890 census, and these populations, they moved a lot. So there were a lot of migration and so on. So there is really like, and I know that this paper will partly be like a methodological paper to know like how to track African American populations, but he's been working on that for several years. So we are looking for one to see the results. Good.
Curiosity satisfied. Speaking of which, if you're interested in bank failures, you're in for a treat. In 2 weeks' time, we'll have the last meeting of this semester for the webinar. And there will be a presentation by Chris Michener and Eric Monet, and the title is Central Bank Losses and Lending of Last Resort. There'll be a banking failure, very embarrassing, involving the Bank of France and in a later period. So stay tuned. Till then, thank you so much again, Claire and Punoor. Fantastic paper, great having you. And everyone else who's still on the call, keep well, and I'll see you in 2 weeks. Thank you.
Right.
Thank you very much.
Bye.
Bye-bye.